Hey there, everyone. Happy Monday. Welcome to Chart This with Dave Keller. It's Monday, November 10th, 2025. I'm your host, Dave Keller, coming to you from a kind of a classic fall day here in Redmond, Washington. Kind of overcast, little wet, kind of comfortable. I'm digging it. Sweater weather. I'll take it. Hope you guys are all doing well. I just talked to a fellow CMT in the Chicago area. My daughter is at school in Michigan. They're both telling me about a great amount of snow on the ground. So if that is your experience, I'm so envious. We get very little snow in the Seattle area, maybe 1 or 2 days a year. Hasn't happened yet. We're kind of 50s and rainy this time of year. So enjoy it. Enjoy the making a snowman, doing whatever you do. The markets were ice cold last week, Friday, with a late stage rally, kind of saving what was going to be one of the worst weeks in quite some time. Today, further optimism, lots of chatter and headlines over the weekend, particularly Sunday evening, about congressional leaders maybe getting very close to some sort of deal to end the shutdown. The market taking that as a great source of optimism today, with the S&P reversing, the pretty weak performance last week to lead the market higher, with the NASDAQ composite up over 2%. We'll dig into that rally. We'll talk about what the conditions in terms of volume and volatility, trend and momentum tell us about what today's rally means. We'll talk about the leadership rotation, what signs would help us sort of validate further recovery as we chart our course through uncharted territories. That was a bunch of puns, very much intended there. Let's get to the charts here. So there's Friday, right? And Friday lunchtime through the close was a pretty decent upswing. Really finished the week off strong, and really salvaged what a decent week from what could have been an absolutely disastrous week. Now, one of the big stories that we talked about through the course of last week, and that we covered in our weekly flight plan for our premium members, was leadership rotation. Right at this point in the cycle, now that we've seen the warning signs that we've covered here in terms of breadth and momentum, it's now structural, right? You look for changes. You look for stocks that had been doing well starting to struggle, which is why last week on some of those days where technology was the worst performer, really sort of jumped off the screen at me. Today, back to growth over value, back to offense over defense. For one day, you've got the S&P up 1.5% to close at 6832. The NASDAQ composite even better, up 2.3%. The Dow positive as well, but lagging behind, up 0.8%. Mid caps and small caps all up, but all up a little less than 1%. So this was NASDAQ. This was large cap growth, and then everything else. You can see the volatility picture improving going into the weekend. We talked about the VIX, spending half of the day above 20. I mean, just at the close, it ended up getting back down toward 19. So up until around 3 p.m. Eastern, it looked like we were going to finish the week with the VIX above 20, which I don't have to tell you is kind of our basic back of the envelope level. So Friday closing below there, and then today further downswing for the VIX. Pretty encouraging, right? I mean, that's an encouraging sign. I mean, what I will tell you when we get to the chart of the S&P 500, we'll talk a little bit more about this. I think if you look at the stats when there's been a government shutdown, now granted, this is the longest shutdown in history, so we don't have a lot of historical, analogs to compare it to. But if you just look at general shutdowns, the market really doesn't like when, the government shut down. There's just uncertainty. It puts pressure in areas that you, like airlines, that you don't really know how to budget for, how to, what that would mean. You don't know how long it's going to last. And as a result, finally getting an announcement that the shutdown is going to be over, the market usually takes that as a pretty good positive. So, tactical move to the upside after a shutdown is confirmed to be done. Highly unlikely we'd see anything but a nice bounce. The question is going to be, in my mind, the sustainability of that bounce, because reopening the government means we reopen all the labor data, all the jobs data, all the inflation data, and there's no guarantee that the market's going to love that updated data. And I mean, anecdotal data could suggest here that the economy is slowing down a lot more than expected. Could bring future rate cuts into question. All of that, we could have just a fire hose of data that all of a sudden makes people start to question the sustainability of an uptrend. So what goes up could come down very, very quickly, given that additional data that we would probably get. I mean, don't get me wrong, no matter what position you're in the markets, I certainly am hoping a shutdown is over very, very soon, because it's creating a lot of friction and a lot of uncertain and unfortunate outcomes that I would love to not be what we're dealing with. Having said that, volatility coming down, markets going up on optimism. A shutdown is wrapping up here very soon. Fingers crossed that's true. Looking at the bond markets, the TLT was basically dead flat for the day. Bond yields kind of chopped around, but in the end, just slightly higher from Friday's close. Not a big move. Dollar, not a big move either. Again, some movement in some of these, but not a real directional move. There was a big directional move in precious metals and the rest of the commodity space. All of the top 8 commodity ETFs tracked here on the stock charts platform, all in the green today. The GLD up 2.7%, silver up 4.3%. Love to see that, because gold has been one of the best trades in 2025. Certainly in my portfolio, that's been a winner. And so seeing further upside, I have no problem with further upside in the GLD. Getting back above moving averages, continuing the upswing would be encouraging. Another 2.7% to the upside. But the rest of the commodity space doing pretty well also. Finally, with cryptocurrencies, Bitcoin did over the weekend again get below 100,000. Did sort of rally Sunday into Monday and spent most of the day in the 105 to 106.5 range. So we are bouncing off of that support at 100,000. I would say for now, Bitcoin an okay chart as long as it holds 100,000. Below 100,000, I think that's a very vulnerable chart. And we'll certainly be tracking this if there's further upside. Higher highs and higher lows are always a good thing. Note that Ethereum prices are actually down today, about 1% lower, while Bitcoin is actually moving higher. Last week, we talked a lot about the growth sectors underperforming, about the previous leadership, particularly semiconductors, lagging big time, having tough weeks, and certain days just absolutely got crushed. Today, we're back to growth over value. Your top 3 sectors for today: technology, the XLK, up 2.6%. Consumer discretionary, the XLY, up 1.3%. Communication services, the XLC, up 1%. 8 out of the 11 S&P sectors finished in the green, only 3 down, and there were 3 defensive sectors. Consumer staples, down about 1/3%. Real estate and utilities were essentially flat for the day. And those are your sector returns, kind of the traditional value plays, kind of in the middle. Our market trend model, as we talked about with our premium members over the weekend, short-term model, I mean, slightly negative. I'm talking like 1/100% below the zero line. So not an overwhelming bearish signal, but it was technically a bearish signal today. All of those short-term models flipping back above the zero level. I don't formally change the model until Friday at the close. So for now, run a short-term bearish signal until next Friday at the earliest. We've had 2 prior 1-week, pullbacks in the short-term model. Both of those, the market went back positive the next Friday. Nice upswing after that. Maybe that's what we see here. All right, looking at the breadth conditions. 2 stocks up for every stock down on the New York Stock Exchange. So decent breadth today, 66% up, 32% down. Similar on the NASDAQ composite, similar on the S&P 500. Midcaps had the worst breadth, but still pretty positive and over zero. So, I mean, to be clear, today was a nice upswing in price, a nice upswing in breadth, a nice upswing in volume. And I have the chart to prove that with the Chaikin money flow a little later in the show today. NVIDIA up 5.8%. That's after a really rough week. Alphabet, biggest weight in the consumer communication services sector, that is the XLC, up 4%. Tesla bouncing higher, 3.7% on the downside. Apple lagging behind the market, only up about 0.5%. Netflix, Meta, Amazon, both up about 1.5%, a little slightly better than that. So all of those things underperforming the S&P today. That's not true. Meta and Amazon actually slightly outperformed, up 1.6% to the S&P's 1.5%. So not a bad day at all for the Magnificent Seven and friends, the big growthy names. All right, let's look at the heat map. This is called the market carpet on stock charts. We'll look at today's trading, dig into some sector and group themes, As a reminder, love your questions. We had an all mailbag episode on Friday. A lot of fun. We had 6 questions that I hand selected that I received from all of you guys through our YouTube channel over the last week. Always looking for some great questions. I've already received a couple over the weekend that I set aside as some potential questions to review this coming Friday. We're planning an all mailbag episode. Would love to answer one of your questions. So please use our YouTube channel. Just drop a comment with your question. And we'd love to feature your question on our next mailbag episode. Looking at the heat map, obviously a great, a very solid day, particularly growthy. You can see a lot of areas of the market that were more flat, and certainly some red areas, which we'll talk about here in a moment. But let's start with the strength. NVIDIA, elsewhere within technology, certainly the semiconductor trade, which did not have a good week, having a nice bounce. So, today with the shutdown, chatter going full tilt here, it's certainly back to the things that had been working off of the April low, certainly working today. So NVIDIA, Micron, AMD, Palantir, Lam Research, CrowdStrike. These are all names that had really strong up moves. So certainly a lot of semiconductors in that bucket that I just mentioned. Within communication services, Alphabet having a pretty good day, up about 4%, depending on what listing you're using for that. On the consumer space, Amazon and Tesla both having good days. Tesla especially up 3.7%. And then with all of that, look at Eli Lilly trading like a growth stock. And this is what I love about something like the heat map here. It quickly points out charts and stocks that are in sectors outside of those growth sectors that certainly look like they should be growthy names. And I love finding a Cummins International, CMI. You literally just have to look for stocks that are in good uptrends, and you'll find charts like CMI. You'll find charts like Caterpillar, CAT. These are good charts. This is a stock that gapped higher on earnings on Thursday, had a shooting star candle on the earnings date, which was not encouraging. But Friday, a nice upside follow through today, eclipsing Thursday's peak and making a new 52-week high. So I like that follow through post earnings on CMI. Anytime you have a gap, the question is it a gap and fail or a gap and run? And I think that's super meaningful right around earnings, right? When a company beats earnings, there's the gap, right? And that's what the gap represents, right? We now have new information. We as a collection of investors have decided this is the new reasonable price or legitimate price for this stock based on the net expectations we all have. But what happens tomorrow, what happens the day after that earnings release, right? The days after is where it's a question of whether investors are willing to buy more of CMI after the gap higher. You basically had, if you look at where it was trading, right? It was closed around 440. All of a sudden it's up to like 470, 480. So all of a sudden the stock's 10% more expensive. And are people willing to pay 10% more than they were pre-earnings for that expectation of further growth beyond what we've learned, right? Are we really pricing in the appropriate valuation based on expected future earnings? And a gap and run is what I call a gap higher, where additional buyers come in and you can see incremental gains after that gap. That's a very encouraging sign where investors are willing to pay more because they're paying for future earnings or the expectation for future earnings. What you don't want to see is a gap and fail, where a stock gaps higher on earnings and then starts to rotate lower, because that tells you we valued the company much higher after earnings, but then where are those buyers coming in that are willing to pay more and more, that are going to push the price higher? They're not there. So in this case, I would argue this is a gap and run. That's actually a pretty encouraging sign. Eli Lilly, I mentioned, is another one. So I would say, again, outside of that, it's very kind of modeled, and it's very kind of randomly spread around the S&P 500 members outside of the growth sectors for areas of strength, but they're there. A couple other things I would highlight. ROK is another industrial name. I'm finding a lot of compelling charts in financials and in industrials. Those are two value-oriented sectors that have shown a decent amount of strength as we're wrapping up, the earnings season here. I would say another example of where we kind of traded lower after the earnings date on Thursday of last week, but then Friday and now into today rotating back higher. Definitely want to call out gold stocks, because they're all sort of lighting up today after gold is rotating back higher. The GLD, of course, a bit vulnerable. We'll look at that chart here in a few moments, but look at Newmont Mining, gapping higher today, up about 5.8%. That puts it back above the 50-day moving average. So that pullback, while it did break below the 50-day moving average, the RSI never really got below 40, which is, basically suggests we're still kind of in this big bullish uptrend phase, because the uptrend phase, because the RSI is sort of in that classic upward, bullish range between 40 and like 80. So pretty encouraging. All right, I think that'll do it for the heat map. I'm going to wrap up now looking at some charts together. As a reminder, if these charts and the comments I'm making bring any questions to the forefront of your mind, please take a moment on our YouTube channel, drop a comment, and let me know. I would love to get your questions. I read everything that comes in on our YouTube channel, and I'd love to hear from you. Maybe we'll answer your question on the next episode. All right, here's our daily chart of the S&P 500. What we talked about last week was, look, the bad news is we've broken below the lower trend channel, which is something we've been covering now for a number of weeks, talking about this potential structure. The good news is the momentum is still fine. The good news is the 50-day moving average is still holding. And what we talked about on Friday is when you trade below the 50-day but close above it, that's usually suggesting that, in the short term, it's kind of a bounce pattern, because we traded below support. Buyers came into the close and pushed us right back above the 50-day moving average. That implies there's some good buying power to lead in the next day or two. We certainly saw that today with that follow through. Again, the news over the weekend definitely gave plenty of reasons why stocks could go higher here. So from a technical perspective, we're back above the 21-day EMA. That's good. That means that red flag for now is kind of rolled back up, waiting for another break below the 21-day EMA. We're back within this trend channel, and we really didn't close outside of it much, right? I mean, if I extend this line, which I should do just a little bit, so we'll keep like the same slope. I'm just going to extend it like way out here a little bit, and I'll do the same with this one. So all this is doing is basically saying, yeah, like we're back within this range. That I think this, that was like a 1 or 2 day little blip where we, just briefly went below. We didn't really close much below it. I might spend some time in redrawing these lines, but anyways, the point is, I think we're back within this channel, and that means conditions are good. RSI held above 40 on that pullback. I think that's encouraging as well. With today's rally, the Chaikin money flow, which is this bottom panel, spiked right back above zero. We talked about this on Thursday's episode, I believe. The Chaikin money flow is rotating below the zero line. And that's concerning, because what that means is that there are big distribution days, big down days on heavy volume. That's what's causing this to trend lower and eventually get below zero. Today, which was an accumulation day, big up day, closing near the highs of the day, decent volume, that's causing the Chaikin money flow to get back above zero. If we can hold above zero, that would actually be a very bullish sign for the S&P 500. Here's the chart of gold. I mean, for now, this is like a perfect case study in using Fibonacci retracements. If you take the May low, which is around 292 on the GLD, if you connect that to the October high, which is just over $400, you can go down 38.2% of the way. That's a downside objective right around 360. That's literally where we bottomed out the last week in October. We retested that support level first week in November. Now we're rotating back above there. So, I mean, this is a perfect example of where Fibonacci retracements for me make a ton of sense. When you have that big run higher, we then have the initial gap lower. The question is, what's a reasonable downside objective that would still maintain the structure? 360 is kind of the level, and that's pretty much where we hit. Look how the RSI really didn't get much below 50 there at those lows at the late October, early November. This is setting up really nicely for another leg higher in gold. This shout out to Dan Bird, who's a viewer of the show, someone I met last year. I want to say, Dan, at a money show, maybe earlier this year. It felt like we've known each other for a while, because we are kindred spirits. Dan is a very capable technical analyst, runs his own site where he shares ideas about charts, and he was very kind to share this chart, which I'm sharing. I'm giving full credit to Dan. This was his design. He was basically, highlighting a pretty well-known phenomenon, which is when a stock or an ETF gets very extended above moving average support, that's often when you get a snapback, right? And it's sort of just something, it's like an RSI overbought condition, right? It's way far away from that moving average. And that's often when you get a pullback. If you look at the SMH, this is a weekly chart with the 200-week moving average. And we're highlighting these times when there's been a 100% gap. So the price of the SMH has been a double. It's been 100% above the 200-day moving average. That's now happened 3 times in the last 5 years. Here in late 2021, the 200-day moving average is down here around 75 to 80, and the SMH is trading up here around 155. So we're literally 100% above. We ended up coming down and eventually trading slightly below the 200-day at that October 22 low. The next time we were 100% above the 200-week moving average was here in mid-2024. We had a big, significant initial sell-off, eventually rolled over into the 2025. Well, it didn't get quite to the 200-week, but definitely got down in that general area. Just in the last 2 weeks is the last time we've gotten, yet again, 100% above that 200-week moving average. So does that mean we are once again entering into a downside rotation in semiconductors? And if so, there's no way that would not weigh very heavily on the S&P 500, certainly the NASDAQ, right? Because these are the stocks that were the heroes in this bull market phase off of the April low, which means they most likely become the villains in the next bearish phase. So certainly an interesting parallel between where we are at and where we're at now, where we've been when the market has been this extended in terms of semiconductors and what's happened soon after. For me, this is just a reminder to look for breakdown signs. As we do, look for breaks of line in the sand. It tells us that we're kind of in a similar place where it's happened before. One of the breadth readings that I think has changed quite a bit here recently is the NASDAQ 100 bullish percent. This is a breadth indicator based on point and figure charts. This shows you that as of Friday's close, 40%, as of Monday's close here today, 42% of the NASDAQ 100 stocks are in a bullish point and figure chart. That's down from about 66, 67% about a week ago. So in the last week, about a quarter of the NASDAQ 100 members, and these are all big, large cap growth names like NVIDIA, Meta types of stocks, a quarter of that index of leading growth stocks has had a sell signal on their point and figure chart in the last week and a half. That is not a good sign. Now, if this bullish percent index can start improving like it did today, but a lot more, get back above 50%, get up into the 60s, that would be a brilliant all clear sign and would validate the gap higher that we saw today on the NASDAQ composite. But if this indicator remains below 50%, I would say the chances of a sustained rally beyond current levels are remote. Coinbase bouncing higher, bouncing off of the 200-day moving average. Literally on Friday, we opened just above the 200-day, traded almost to the penny to the 200-day moving average before closing at the highs of the day. Today, gapping higher a bit, traded a bit lower through the course of the day, but still up about 2.8% from Friday's close. I like how the momentum is hanging in there. I like this test of the 200-day and holding that, also holding 300, which was support from August and September. We're kind of right at that point where this is where you would expect a meaningful low. And if not, if we go below 280, which is an alert I'm setting right now, I'm actually writing it on the on a piece of paper, that would be a disastrous sign for Coinbase. Coinbase, of course, tied pretty closely to Bitcoin, Ethereum, and other cryptocurrencies. They're bouncing into this week, and that's an encouraging sign for that stock. All right, 2 more. Boeing, a Seattle-based name. This is one that came up in our recent live Q&A, if I remember right. A rough chart, and I would say with stocks like this is why I watch the 200-day moving average specifically for stocks that are unable to hold the 50, or excuse me, when they're unable to hold that 200-day moving average. What has happened now in the last month, besides a disappointing earnings report that took us down to the 200-day, look at the additional selling that happened after. And again, this is where I think gaps around earnings can be so informative, because when you have a gap lower on earnings, that means there's a disappointment. People were not happy with what they heard. Expectations for the future have been tempered. But what happens after that, after you have that gap down in earnings, it's like having a 10%, 20% off coupon for a great company, if it is a great company. So if people are optimistic about the long-term growth and they see this earnings miss as an opportunity to get in at a weaker level and ride the next price higher, ride the next move higher, we should see buying start to come in. We should see optimism reflected in prices starting to turn higher. We're not seeing that. We're seeing additional distribution after that earnings miss, which tells you people are cashing out around earnings and then continuing to not see buyers come in. The RSI, by the way, has been below 60 since August, and that's been in line with that pattern of distribution. All right, final chart, Stanley Black & Decker. I did my weekly show for Stock Charts TV earlier this afternoon. I would encourage you to check it out on the Stock Charts TV YouTube channel. There was a article recently, report published by Wells Fargo, where they highlighted 10 stocks that they felt could benefit if the tariffs, the trade tariffs were unwound, right? If the Trump administration was forced to unwind some of these tariffs for whatever reason, which companies felt the pain when the tariffs were announced and, by logical extension could, see renewed optimism if tariffs are now off the table. And the 10 stocks that you'll see in that video were mostly in consumer discretionary, which makes sense because those are a lot of companies that build stuff outside the US, import them in and sell them at like a retail store, or industrial companies like SWK, where they're getting components from outside the US, from China or somewhere else. They're bringing in the raw materials, they're building stuff and then selling them. Either one of those types of companies is going to have to, a tariff is going to be involved, and most likely that just makes it it makes it a challenge. And so these are stocks that got hurt and came down quite a bit, had their earnings estimates come down after the tariffs were announced. SWK was one of those. I'm highlighting this as one out of the 10 to focus on, because for me, I think it's a perfect example of where I think you need to be patient. If you're really bulled up, if you think, look, I think the tariffs are going to go away and I want to buy stocks that I think are going to benefit, and I think SWK is one of those. Like, I get that logic, I get that logical investment thesis, but from a technical perspective, what is the chart telling us? The chart is telling us that optimism that you're feeling is not being reflected in the price yet. And how can we quantify that? Well, if we take the October 24 peak, which is the previous all-time high for SWK, we take the April low, which most stocks had that first or second week in April, 38.2% of the way back up is $73. We see that served as resistance a number of times. We actually broke above that, ended up getting right back below it. It once again has served as resistance. So I think getting above 73 would be a really good sign that we do not have yet. Also, I would say we're making a higher low here in the early November. That's good, but we're also making lower highs. So it's more of a coil pattern, which means you need to wait which way it resolves. But we would want to see that resolve higher, right? And break above a trend line using those previous highs. Also, a break above 73 would clear the 50-day and the 200-day moving average. And that's been, a level we've been holding below. The momentum is very negative with the RSI consistently below 50. So an improvement in all of those things, right? Getting back above Fibonacci levels, getting back above moving average resistance, making a new swing high, improving momentum, those would be the technical pieces of evidence that for me would help me validate, okay, this thesis that I have in mind about tariffs, the chart's actually telling me that's starting to play out. For me, I'm happy waiting for that sort of catalyst, but use the chart to your advantage. Folks, that'll do it for today. Thank you so much, as always, for joining me on Chart This with Dave Keller. It's a pleasure to recap some key charts with you and some market movements every trading day after the close. Please, by the way, we had some great episodes of the Market Misbehavior podcast recently. Just last week, I had 2 episodes of the podcast that we recorded. Jerry Robinson, who's the founder of followthemoney.com, great discussion about trend following, some of the tools and techniques that he's found helpful. Steve Bavaria, I sat down with him. He's the author of The Income Factory, talked all about income-focused investments outside of equities, talked about closed-end funds, BDCs, acronyms like that don't make sense to you. Make sure you watch that interview with Steve Bavaria. We'll answer all your questions and more. For now, I'll say have a fantastic Monday evening. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.